Okay, so chapter 6, I lost my screen, there we go. Chapter 6, we've been talking about two different types of companies, right? Sales and service. Yep. And what's the difference between the two?
I won't tell.
You won't tell? What is a sales company? Selling merchandise. And that's the kind of company that we're focusing on. Then we talked about two different types of inventory. Huh? Periodic and perpetual. Perpetual means that it is continuously being updated, right? And periodic, the only way you know what's in inventory is if you go and check it, right? You have to go and check it. Huh? And the nursery was an example there. Good memory. Okay. So we went through, we talked about FOB shipping point and FOB destination. FOB shipping point means who pays for the shipping? Who's responsible?
Buyer?
The buyer. On FOB shipping point, as soon as it leaves the dock, the buyer becomes responsible and the buyer pays the shipping. It goes in the buyer's inventory. FOB destination, the seller is responsible for the shipping and it remains with the seller's inventory until it reaches the buyer. Okay. We also talked about things like consignment. Who takes control on consignment? Whose inventory? Yours. The person who owns it is the person who inventory it is. It stays with them. Even if someone else is selling it for them, that doesn't matter. It remains with the person whose goods they are until it's sold. Then we worked ourselves into the journal entries. So let's start with the purchases. So with the purchases, what happens when I buy something? I buy something on account. What's the journal entry for purchasing $1,000 worth of merchandise on account?
Accounts payable.
I'm going to debit accounts payable and credit what?
Inventory.
Does that look right?
No.
No, that doesn't look right. Let's try that again. If I buy something on account, I'm going to debit inventory and credit accounts payable. So I bought $1,000 worth of goods. I debit inventory, credit accounts payable. Now let's say I returned $500. Now we do a debit to accounts payable and a credit to inventory for $500. All you have to do is reverse the journal entry, right? Now, if we bought it on account, they gave us terms of $230, net 60. 230 and 60. What does that mean?
If you pay in 30 days, you will get 2% discount.
Okay, and what's the N60 mean?
After 30 days, you have to pay in full.
Okay, after 60 days, you have to pay in full. You get a 2% discount for what you pay in 30. The rest is due in 60. So if you don't pay the whole $500, you have to pay the rest in 60 days. All right? So 2% discount. So now what happens if I go ahead and pay my balance? How much do I owe them? I bought $1,000 worth of goods. Do I owe them $1,000? No, I owe them $500 because I returned $500. So what's the journal entry going to look like when I pay them back? I'm going to debit what account? Accounts payable. We got to make accounts payable. I'm going to debit for how much? $500. You got to take the whole $500 out. Then I'm going to credit cash. And Faisal, you figured out how much?
$490.
$490. Sounds right. And where's the extra $10 go?
Discount.
Yes, purchase discount, but it should go into what account? Inventory. So a debit to accounts payable, credit to cash, and a credit to inventory. Why do we put that into inventory?
Because of the cost of goods.
Okay, let's do a T account for inventory. So on the T account for inventory, we originally purchased $1,000, so we debit $1,000. We returned $500, so we credit for $500, which means we have $500 worth of goods in inventory. If we now get a discount of $10, that means inventory is worth $490. So that's just showing that we actually make more money on it. So if we sell this inventory for $600, we don't make $100, we make $110 because we got a discount on the price of the inventory. That's why you want to put it as a direct reduction of inventory. Now, the one journal entry I didn't include in this, which I should have, is what if we would have had to pay to get that inventory in? What if we had to pay shipping? What would the journal entry look like to pay $200 in shipping?
Inventory debit.
Inventory debit
And cash.
and cash shipping. All right. And that would have actually, we would have increased the cost of inventory by $200. Because now we can't sell our inventory for $500 or $600. We paid $200 in shipping. That just increased the value. So now in order to make money, we put $1,000 of inventory, we returned it for $500. It cost us $200 to get it, so our inventory is worth $700. We got a discount of $10 when we paid it, so our inventory is worth $690.
So you wouldn't take the discount of the total with the shipping?
No, because the shipping we paid cash. The shipping was not to the individual. Now, for some reason you paid the company that you bought it from, then you could possibly. But usually the shipping is going to be separate. So $690. So now we need to sell it for at least $690 in order to make money.
If you want to make a T account for cost of goods
Sold.
so it will.
Now remember, cost of goods sold is only going to be when we're selling it, not when we're buying it.
No, I'm asking about the T account.
Right.
If you want to make it so it carries a debit balance.
Yes. Okay, so now we have all the goods. We want to turn around and sell it. What's the journal entry going to look like when we have a sale? So let's say that we sold all these goods that we just bought, and we sold it for $2,000. These goods cost us, let's round this up, the goods cost us $800, but we sold them for $2,000. What's the journal entry going to look like?
And sales revenue.
All right, so accounts receivable, we're assuming it's on account. That's good. And sales revenue is the credit for $2,000. Am I done? No. What's the other part?
Cost of goods.
We're going to debit cost of goods sold and credit
Inventory.
inventory for the, what did I say? 800. See, when I make up numbers, I forget what I made up. All right, so we sold a $2,000 worth. It cost us $800, so how much money did we make?
$1,200.
$1,200. We did good, right? I made us a nice profit. Yeah. All right, so now they returned it. They are going to return, I didn't do a very even return here, so I'm making it up. They're going to return $500 sales, and that is $200 worth of goods. All right? I don't care if it's equal, don't do it. So with $500 worth of sales, $200 worth of goods. What is the journal entry? Now remember what we did here when we had a return. What did we do with the journal entry?
We will debit the inventory.
Right, so all we did was flip it, right? All right, so we're going to debit.
Inventory.
All right, so let's do yours because you're doing it in order. Hang on, go ahead. We're going to debit sales and credit for the $500 that I mentioned. Then we're going to debit inventory and credit cost of goods sales, cost of goods sold, for $200. They returned one of the more expensive items. All right. So that's our return. So this is our sale. This is our return.
We have to write this in order, right?
Well, you don't have to. It's good if you think about it in order. If you would have put the inventory first, that's fine. I just need to see both entries. Okay? All right. What's the shipping look like if I would have paid for shipping on this item to ship this out? $200. A lot of shipping. Let's do $100. I paid $100 to ship this to the person who bought it in cash. Yep. Shipping expense, freight out, whatever you want to call it, in cash. When the sales people pay shipping, it's just an expense. On the purchasing side, it goes into inventory. On the sales side, it's an expense. All right, and then the last step on this side is they paid us. And they paid us within the discount period. And their discount period, because we're just going to make this whole problem messy, is 3/30. That got you on that one problem. 3/30 and 60. So let's figure out how much do they owe us. Oh, that's fine. Do a T account, right? I want to make sure that you remember the return because on the exam, that's one of the things you forget to do. On your homework, you got to yell at me if I get in the way. How much do they owe us? $1,500. So we sold 2,000. They returned 500. Shipping does not count. So they owe us $1,500. So what's the journal entry going to be? Are they paying us?
Yes.
So what are we going to debit?
Cash.
Cash. How much cash am I going to get?
1,500.
Am I getting $1,500? They're paying in the discount. What am I getting? $1,455. What am I going to credit accounts receivable for? $1,500. Yeah. Then I do a discount for $45, and what do I call it?
Sales discount.
Sales discount. So those are our journal entries for purchases and sales. And the one thing to try to keep in mind when you're doing these is everybody that buys goods has to sell them. So a company's doing both of these journal entries. This is accounts payable person is doing the journal entries for purchasing because they're going to, and this is the accounts receivable person. Most companies have both. And I say most. The company that I keep referring to during the semester is the company my brother works for. They don't. They have one accounting person. So that person does accounts payable and accounts receivable. And they actually outsource that even to Reuben Brown, the company I used to work for. So small companies, they have about 40 people. But the majority of the people that work there are sales, sales support, developers, one IT guy, maybe two IT guys, and the two partners. All right? So they outsource and they have an accountant come in, I think 2 days a week now. And then whenever something bad happens, they hire a full-time accountant that works for them for several years and then they decide they don't need one and they go back to paying someone part-time. It's a vicious circle. It's hard for smaller companies because it is hard to justify needing someone full-time, but you need someone that has a very broad knowledge of accounting because they have to do the journal entries and they have to do payroll and they have to do your financial statements. They have to do everything. So it's hard to find that person. All right, so we covered almost everything in here. What are the two formulas that I said you want to know?
Beginning inventory.
So beginning inventory plus purchases gives you what?
Cost of goods available.
Cost of goods available for sale. And then what?
Minus cost of goods.
Minus cost of goods sold
Equals ending inventory.
gives me ending inventory. All right, the other one,
Next is minus cost of goods. I don't know.
Sales
sales.
minus returns and
Well, that kind of goes there. So to get net sales, you take sales minus returns and allowances minus discount. And that gives us net sales. Net sales minus cost of goods sold gives me what? Gross profit. So those formulas. If a problem doesn't give you net sales, if it doesn't specifically say net sales, you can assume it is. Sometimes in your homework, you need to calculate gross profit, but it doesn't say net sales, you can assume it is net sales. All right? If they don't tell you, if they don't give you returns, but they tell you what is net sales, you can assume sales is net sales. Sometimes it doesn't go that deep into it. All right, so let's figure out. I think this was the last slide that we stopped on. Waiting for it. Oh, there we go. I think that was the last slide that we stopped on. Okay, and what's weird is it's on your screen and it's not on my screen. There we go. All right, and we talked about the fact that now that there's something with expected returns that has to be recorded. If you know you're going to pay cash, it's going to be called a refund liability. Even if you haven't paid it, you have to record it. And that's important. And then there's also something called, when you know you have to return goods, you actually call it estimated returns, and that's also a liability. And I think it's still in your book here, but the reason this is so important is sales is a big audit issue. Because if it's a true sale, it needs to be out of your warehouse before year end. A sale is not saying you sold something on December 31st and it's still sitting in your warehouse. That's not a sale. And there has been companies that have gotten in trouble for that because Bausch & Lomb actually sent out a whole bunch of contacts one year to all different optometrists and opticians and all the different contact places and glasses stores without being asked, and recorded them all as sales. Now, if they were not requested, but yet they sent them all out and recorded them as sales, what do you think all the different contact glasses stores, Clarkson Eyewear, all those different places did when they got these shipment of contacts that they didn't order? They returned them. So what happened in the following year? They had a huge return. So you can't, they got in trouble for that because it was millions of dollars that they sent out. You cannot do that. All right, that's why stores like Macy's and Target and all these different retail stores, their year ends are not December 31st. They're usually March 31st. They get through the holiday, right? And then they get through the returns of the holiday, and then they do the year end. Plus, a store like Target is not going to have their year end be December 31st. They don't have time to do the closing. They're in the middle of their biggest time of the year, so they close in March 31st. You can pick the time of year you want to close. A lot of manufacturing companies close September 30th. They get through the summer. My dad used to work for General Dynamics, which is used to be part of Chrysler, but he used to build tanks, parts of tanks. So he's an engineer. Their year end, they were always off 2 weeks in the summer. They shut down the plants. Well, they shut down the plants because that was their year end, and that's when they closed all the books and they did all their maintenance, and then they closed their year end. So a lot of plants kind of do that type of different maintenance. So then we showed this slide where you have your sales revenue discount ending up with your gross profit. All right, and that got us to this slide. So let's go ahead and do a problem so you can stop listening to me. Maybe not. Yeah, nope. Okay. All right, so the next thing we're going to talk about is bundled sales. And I briefly mentioned, I'm going to leave those formulas up there. I briefly mentioned this to you guys. So a bundled sale is when we buy two things for the price for one single price. And if you think about it, that's how you buy a house. When you buy a house, you buy the land with it. But they don't sell it to you like that. You go and buy a house. There's a house over here. Actually, there used to be 3 right next to the gas station. All 3 of those or 4 of those were for sale. And honestly, for right by a college, they're perfect kind of like rental houses if you want to rent. But you're going to have constant renters. Next to a 2-year college, you're just going to have kids in there 1 or 2 years. But when you buy that house, and I have no idea what the price is, but let's say they're $200,000 houses because they're in Kirkwood. All right. You're buying that house, that land is probably worth right there as much as that house or more. Because in Kirkwood especially, the land is worth a ton. And that's why when you're driving through Kirkwood, if you go down these little streets, you will see little house, big house. Big house, little house. Especially if you go down Geyer. You will see a new house, a new house, a new house, and then this little house. Because what happens in Kirkwood too, and we have friends that did this, when people pass away or older people move out, they leave the land and the house to relatives, and they tear down the house and they put up a new house because the land is so valuable. And that's what our friends did. Her grandma passed away and left her the land with the house, and the house didn't meet any code possible. So they tore down the house and they put up a new house and have a pool, and now they live in Kirkwood. And it was cheaper to do that than fix the house. So when you buy that $200,000 house over here, they don't tell you the land's $100, the house is $100. They just say it's $200,000. Then you decide what you want to do. And that's how a lot of purchases are made in the business world. So SiriusXM, we're not doing land here. We're doing a package deal. They're selling a 12-month radio service package in which they're combining a whole deal for $200. They're going to give you a radio and service. So they're giving you the equipment and they're giving you a package. They're selling it to you for $200. Sold separately, the equipment and the radio would sell for $100 and $150. So we got $100 and we got $150. All right, and I think this is the equipment and this is the radio. I mean the service. All right. So, but together you're going to get it for $200. So you're saving. That's how they get you into some of these things. They kind of do that with your cell phone packages sometimes too, right? So the performance obligation for the equipment is fulfilled as soon as you buy it. So as soon as you buy that, you're done. But this is a 12-month deal. So Sirius Radio cannot recognize the full $200 because the part that's done with the service deal has to be recognized over 12 months. So you need to figure out how much of that $200 needs to be recognized over 12 months. Then it goes on to say, okay, assume that they pay the $200 on October 30th. They receive the equipment on October 31st. The subscription starts on November 1st. So that's your first full month. They held the equipment and inventory at a cost of $35. So they're selling it for $100. Your cost of goods sold is $35. So somewhere in this process, cost of goods sold is $35. So we got to figure that out. All right, so they kind of go through. Now this looks like a big process, but once you figure it out, it's easy, I promise. All right, first you got to figure out what's going on. We already just did that. They're buying equipment and they're buying a service contract. All right, what is our obligation? Well, we have to give them service for a year. What is our total price? $200. How much goes to each one? That's what you have to figure out. And then recognize when the revenue is due. Well, how do we figure out how much goes to each one? You've got to figure it out proportionally. Well, how do we do that? Well, originally it was $250, but we gave it to them for $200. So what you do is you say $100 over $250 and $150 over $250. That was the original price. That means that this one is 40%, and that was originally 60% of the value. Of 250, it's 40 and 60. So now you take that times the new price. So of the $200, 80 of it's going to go to equipment, 120 of it's going to go to revenue or to the service contract. So because it's no longer worth $250, it's only worth $200, you have to figure out how to allocate that $200. So does that kind of make sense? A little bit, at least a little bit. Then on top of that, $35 of that we know is the cost of the item. So $80 plus we got the $35. So what are we going to look like in the journal entry? All right, well, we have cash and deferred revenue. What part of this is going to be our deferred revenue?
Service.
The service contract, right? All right. We also going to have sales, inventory, and cost of goods sold. So I'm going to go backwards a second. Hang on. So those are our journal entries. So let's take a look at it. What do you think we're going to put in there? How much?
120.
Well, it's deferred revenue. So how much cash did we get? You're right. How much cash did we get?
200.
Well, we got 200, but how much of it is deferred revenue?
All of it on the sale.
All the 200?
No.
On the sale, yeah.
Okay, now let me show you the next journal. I'm going to show you both journal entries, okay? So this is the first one. Let's write it on the board. Cash and deferred revenue, or unearned revenue, I don't know why I just wrote that out. Okay. And then the next journal entry talks about the fact that we got the equipment and we have to reduce inventory. So we're going to have cost of goods sold, inventory, and then notice it also has deferred revenue and sales. And then we have one more. That's going to happen at the end of November. So look what's happening there. Then we recognize revenue. So this happens right at the beginning, and then this is in November. Revenue, sorry. All right, so there's our 3 journal entries. This one's a month later, so keep that in mind. So what do you think we're going to do?
On the 30,
On this one, or go back?
go back. Yeah, that one.
Okay, what are we going to put?
200.
So we're going to do cash for 200 and deferred revenue
For 200.
200. All right? So because what did we actually get when the cash was received? We got the full 200, right? But can we recognize anything right then? No. We didn't earn anything right then. We didn't earn anything. We didn't give them anything as of that date. And if you don't remember, here, let me go back one more slide.
Yeah.
It said we sold it originally on October 30th. They didn't even receive the equipment to the 31st. So on the 30th, we didn't give them anything. So they can't recognize the revenue for anything because we didn't give them anything. It's
You
not,
are selling, right?
we're selling it, but we didn't give them anything yet. We didn't even give them the equipment. They didn't use Sirius yet. We didn't give them anything yet. So they cannot recognize it. So Kalanda's right. Now, on the 31st, we gave them the equipment. They took the equipment. So what are we going to put here? Well, the one thing should be easy. What's going in cost of goods sold and inventory?
35.
$35. Because the equipment has to come out of inventory. So cost of goods sold and inventory. What are we going to put for out of deferred revenue and sales?
100.
The what?
No, 80.
80. Why is it 80? Because we figured out only 80 of it because we had to break it out between the 2 items. So now what's left is 120, and that is the service contract. Now, let's go to the last journal entry. Now it's November. There's $120 in the service contract. The contract's good for 1 year. How much gets recognized with 1 month?
$10.
$10 a month. You take 120, divide it by 12, $10 a month, you recognize that money because they're paying for a service. So every month you'll recognize it. It's just like prepaid rent or prepaid insurance. They prepaid for Sirius Radio. How many of you guys in here have Sirius Radio or XM? Anybody in their car? I just thought mom and dad might be paying for it. I didn't know. All right, I actually got it back again because I got a new car. Remember I told you I got a new car? I love it. I haven't had it since I had my old new car back in 2008. So I love having it again. But my husband's always had it. That was his birthday present every year from my parents, was they paid for his Sirius Radio. But you pay for it, like in January, you pay $120. It actually is, I think, $120. You pay for it for the year. You can pay monthly, but if you call and tell them you're going to cancel, you get a better deal if you pay for it for a year. And like mine came with my car, I think, for 6 months. When it's up, I'll say no, and I'll go a month or 2 without it. And then they call you and they try to get you back and you get a better deal. So they have to spread it out over the when you earn it, just like baseball tickets, just like any other ticket that's out there. All right, how many people are confused by that? Okay. The 80? Okay, so the 80 came from the fact that we paid, originally, the equipment and the service contract were worth 100 and 150. All right? So that totals 250. But they only paid $200 for all of it. So we gave them a deal. We said if you buy this, it won't be 250, it's only going to be 200. So you have to figure out how to allocate the price between these two to $200. So you take it as a percent. $100 over 250, it was 40% of the original price. So then you take 40% times 200, you take that percentage and you multiply that by the new price of $200, and it says 80. So this is now worth $80 of the 200 you spent, and the service contract is worth 120 of the $200. So that's the new price. It's no longer $100, it's $80. And that's because you got a better price for having it.
Can you please repeat this transactions?
Okay, so then when the transaction, let's back the slides up. Then when the transactions go through, and I put these slides online too, so I'll write on the slides now. When the cash was received, all right, the cash was received here, you get $200 because you have to record the fact that you got $200, and then you're going to defer the revenue until later. I don't know why it's not showing up on there. It's showing up on here, and it's showing up on there. It'll show up when I put it, okay? So it's $200, just like I have on the board. You have to recognize the fact that they got it. All right. Then, on the next slide, we have to record the fact that they got the inventory. All right. We know that that inventory sits in there at $35. That equipment is in our inventory at $35. That's the cost of goods sold. So we have to take out $35 of inventory, and $35 is our cost of goods sold. So we take that out. That's that first part, cost of goods sold and inventory. Then we can record the sale, the revenue we earned on that equipment. And that we said was $80. Instead of $100, it's $80.
Yeah.
Okay? So we take that out of deferred revenue. And that's where that had been, was deferred revenue. And that's from the slide before that Kalanda said $200, right above the $200. We deferred $200 of revenue. Now we're going to go ahead and recognize 80 of it because they took the radio. They took the radio, so we can earn the $80 from the radio, of which $35 was inventory. And then the last slide talks about the service contract. And that is $10 a month. And the reason it's $10 a month is because it's $120 and we have 12 months that we have to carry it over. So we're going to divide that over 12 months. So every month we're going to recognize $10. There'll be a homework problem, I believe, that's going to talk about that. And we'll do one in class too, I hope. I'll find one.
Maybe a quiz.
Maybe a quiz problem.
Because they didn't have that in the homework program.
Well, I didn't have one in there, dang it. But you need to know how to do it. So I'll find one for us to work. All right, so the multi-step income statement. We've already kind of been doing it. So this isn't like this is brand new when you're looking at it. So when you're looking at the multi-step income statement, what they're talking about is now you just have lines. All right? Now you just have lines. So gross profit, income from operations, income before income taxes, income tax expense. When you're doing the homework, that is sometimes what gets missed. I had, especially online students, I had text me saying, I did everything, but yet I'm getting no points on one of the homework problems. And it was those totals. All right? It was, you had cost of goods sold, you had gross profit, but they were missing income from operations, income before income taxes, income tax expense. They didn't put those numbers in there. But they had net income. But they didn't understand why they didn't get all the points because they actually had the right number for net income and they had that right. Make sure you put all those totals in there. And that brings us to one of our ratios, gross profit. All right, gross profit is very important. And I tell everybody this because you need to look at gross profit. That is the most money Walmart can make. Walmart cannot make more than $120 million. That's a lot, but that's the most money they can make because they sold $481 million, but it cost them $361 to get that. So no matter what all these expenses are, the most they can make is $120. So whatever their goal is, they have to keep that in mind because a lot of these expenses you can't change. And we already talked about, you know, these income, this right here, other expenses, income taxes, those are based a lot of times on this number. Income taxes is based on your income. So you can't change that. That's just what it's going to be. So you got to draw down into the selling, general, and administrative, and usually the biggest general expense that you can change is wages. So that's what you got to look at. So gross profit, those cost of goods sold is a lot of times where you got to try to focus. And honestly, that's where Walmart beats a lot of people, because their cost of goods sold is very cheap, depending on what you're trying to buy. But what Walmart also does, if I'm not a Walmart shopper, I think I've already stated that, so you got to keep that in consideration when I talk. Okay, I'm biased on the other end, but they do a lot of loss leaders. All stores do loss leaders. All right, Walmart does that a lot. What that means is they bring you in the store with items that are significantly cheaper, but that doesn't mean all items are cheaper. And Costco and Sam's does the same thing, and I shop at Costco. There's a lot of things you can get there that are cheaper, but there's a lot of things that are exactly the same price. So you just kind of got to watch what you're shopping for. All right, so let's look at some gross profit analysis for Walmart. Notice the one thing here. They were the same in cost of goods sold went up. Their revenue, actually, their sales went down, but their cost of goods sold went up. So that's why, but yet their gross profit went up, because they kind of changed with each other. It's kind of weird. Cost of goods sold went up by $500,000, but this went down, their gross profit adjusted. Here, it went up, gross profit went up. But what happened here is their gross profit and their sales went up there. So if you adjust, if your cost of goods sold goes up, and if you look at, go back to this slide, that was their gross profit, not the cost of goods sold, sorry. I don't know what I was looking at, but their gross profit went up and their sales went up. Sorry, their gross profit went up and their sales went up. So when their gross profit goes up, your gross profit percent's going to go up. Notice their sales went up in 2017. What would probably be the question for Walmart is, why did their sales go down in 2016? Because the economy had turned around. I'm not sure why, and I don't have an answer. That's just a question I had out there for you. Why did we come down from 15 to 16? They did rebound in 17. I don't have an answer for that one. All right, so gross profit is very important. What are some industries that, it's not in this slide anymore, but they had it in the old ones. What are some industries that have a really high gross profit? Soda, the soda industry. Now there you gotta be careful, because the packaging brings it down. But yes, at like a convenience store, they make a whole bunch of money on soda, right? Because this thing, I just happened to stop today because I'm out of the thing I drink at home. But how much did this cost them? Okay, and this is iced tea. I think it might be cheaper than soda. I'm not sure. Whitney? A what? Car lot? All right. Now the car lot itself, possibly, yeah. Because the lot itself, what's the overhead? Not a lot. Cars are not a high gross profit, but a car lot. What about, I mentioned this before, what about a nursery? Is there a lot of overhead on a nursery? No. The floral industry, not a lot of overhead. And I'm talking about outside floral industry, not one that has to keep things on the inside and whatever. All right? All right. Gas stations and convenience stores, yes, but the oil industry and stuff, not necessarily. All right. And then what was another one that was on there? I think sporting goods was pretty high too, which that one surprised me. I can't tell you exactly why. But things that have a high gross profit are industries that don't have a lot of brick and mortar. Not a lot of things that they have to supply. All right, so let's work some problems. Nice stuff.